Hey everyone, welcome back to the channel. So today we're talking about something that sounds simple, but that most people genuinely struggle with: why you should actually be saving money. And I know that sounds basic, but I think a lot of people know they should be saving without really having a clear picture of what they're saving for. And when you don't have a clear reason, saving feels like deprivation instead of progress. So today I want to give you 7 concrete reasons to save money that go beyond just, it's the responsible thing to do. Because when you connect your savings to a specific purpose, your motivation changes completely. Let's get into it. Reason number 1, your emergency fund. This is the foundation of everything else in personal finance. Before you invest, before you save for a vacation, before you do anything else, you need money set aside for the unexpected. Because the unexpected is not a possibility, it is a certainty. Your car is going to need repairs. A medical bill is going to show up. At some point in your working life, you may lose a job or face a gap in income. The question is not whether these things will happen. The question is whether you'll be prepared when they do. Here's the sobering reality. Nearly 30% of American adults would need to put an unexpected $400 expense on a credit card or borrow money to cover it. $400. That is not a large emergency. That is a car repair or a copay. And nearly a third of adults don't have that sitting in a savings account. The target for an emergency fund is 3 to 6 months of living expenses. That might feel like an overwhelming number when you're starting from zero. So start smaller, get to 1 month first, then build from there. Even $1,000 in an emergency fund changes your financial stability more than almost anything else you can do because it breaks the cycle of every unexpected expense turning into debt. Reason number 2, retirement. And the earlier you start, the more dramatically the math works in your favor. Here's a simple example that I think puts this in perspective better than anything else. If you invest $100 a month starting at age 25 at a 6.5% average annual return, by the time you're 55, you have over $103,000 from $100 a month. The reason the number is that large isn't the contributions. You only put in $36,000 over those 30 years. The reason is compound interest working on your behalf for 3 decades. Wait 10 years and start at 35 instead, you end up with about $46,000 by age 55 from the same $100 monthly contribution. Same return, same discipline, less than half the result, just from waiting 10 years. The point is not that everyone needs to invest exactly $100 a month. The point is that time is the most valuable ingredient in retirement savings, and every year you wait makes the math harder. If your employer offers a retirement plan with a match, contribute at least enough to capture the full match. That is an immediate guaranteed return that nothing else in personal finance can match. Reason number 3, a down payment on a home. Home ownership is still one of the most powerful wealth-building tools available to most people. And the path to home ownership runs directly through your savings account. The traditional target is 20% down, which eliminates private mortgage insurance and gets you better interest rates. On a $350,000 home, that's $70,000, a serious savings goal that takes real planning and time. But here's what a lot of people don't realize. You don't necessarily need 20% to buy a home. Government-backed loan programs through the VA, FHA, and USDA allow qualified buyers to purchase with as little as 3.5% down, or even 0 down in some cases. The key is having a clear savings target, a timeline, and the right savings vehicle to get there. A high-yield savings account earning 4 to 5% APY makes every dollar you save toward a down payment work harder than it would sitting in a standard account. Reason number 4, making your money work through smart savings vehicles. This one is about where you keep your savings, not just how much you save. And it matters more than most people realize. A standard savings account at a big bank might earn 0.3 or 0.4% interest. That means $10,000 sitting in that account earns about $40 a year. A high-yield savings account at an online bank can earn 4 to 5% on that same money, over $400 a year. That is 10 times more for doing absolutely nothing different except choosing the right account. Beyond high-yield savings accounts, there are other options worth knowing about depending on your timeline. Money market accounts offer flexibility with slightly better rates. Certificates of deposit lock your money for a set period in exchange for a guaranteed higher rate, useful for savings you know you won't need to touch. Savings bonds offer inflation protection. The right vehicle depends on your timeline and how accessible you need the money to be, but leaving savings in a low yield account when better options are widely available is just leaving money on the table. Reason number 5, saving for big purchases so you don't pay extra for the privilege of buying on credit. Here's a principle that doesn't get talked about enough. When you save up for something and buy it in cash, you pay the purchase price. When you finance it, you pay the purchase price plus interest, sometimes a lot of interest. Over the life of a car loan or a high-interest credit card, that difference can be hundreds or even thousands of dollars on the same item. Think about a car. If you finance a $25,000 car at 7% interest over 5 years, you end up paying about $29,700 total. Save up and pay cash, and you pay $25,000. That $4,700 difference goes back in your pocket. The same principle applies to vacations, electronics, furniture, or any other major purchase. Saving up in advance means you pay less for everything, and there's a psychological benefit too. When you've saved for something and paid for it outright, there's no lingering debt hanging over the enjoyment of the purchase. It's yours, fully, the moment you buy it. Reason number 6, sinking funds for irregular expenses you know are coming. This is one of the most underused saving strategies, and it prevents a huge amount of financial stress. The concept is simple. You set aside money regularly for future expenses that are predictable even if the exact timing or amount isn't perfectly known. Car maintenance and repairs, annual insurance premiums, holiday gifts, property taxes, home repairs, medical deductibles. These expenses feel like surprises when they hit because we don't plan for them proactively. But they're not actually surprises. They're predictable costs that happen on a recurring basis. If you spend about $200 a year on car maintenance and repairs on average, that's $100 a month you should be setting aside in a dedicated sinking fund. When the expense hits, you pull from the fund instead of your emergency savings or a credit card. Your emergency fund stays intact for actual emergencies. Your credit card stays paid off. And an expense that used to feel like a crisis just becomes a planned withdrawal from an account you built for exactly that purpose. And reason number 7, education, whether for yourself or your children. The cost of higher education continues to rise, and it represents one of the largest financial commitments most families make. Average in-state tuition runs around $9,150 a year, out of state averages over $27,000. And that's just tuition, not room, board, books, or living expenses. If you're saving for a child's education, a 529 plan is worth serious consideration. Money in a 529 grows tax-free, and withdrawals for qualified education expenses are also tax-free. Depending on your state, there may be additional tax benefits for contributions. Starting early and contributing regularly to a 529 can make a substantial difference in how much of a college education you're able to fund without loans. And don't overlook investing in your own education and professional development. Certifications, skills training, and continuing education can meaningfully increase your earning potential. And higher earnings means more capacity to save for everything else on this list. All right, let's land this. 7 reasons to save. An emergency fund that protects you from the inevitable unexpected. Retirement savings where time and compound interest do the heavy lifting. A down payment that opens the door to home ownership and equity building, smart savings vehicles that make your money work harder, cash savings that eliminate the interest penalty of financing purchases, sinking funds that turn financial surprises into planned expenses, and education investments in yourself and your family that pay dividends for decades. The reason saving feels hard for most people is not that it requires sacrifice. It's that the connection between saving today and the benefit tomorrow isn't concrete enough. When you attach your savings to a specific purpose, an emergency buffer, a retirement number, a house, a vacation you've been dreaming about, it stops feeling like deprivation and starts feeling like progress towards something real. Pick one of these 7 reasons that resonates most with where you are right now. Open an account if you need to. Set up an automatic transfer. Start small if you need to. The habit matters more than the amount in the beginning. If this was helpful, drop a like and subscribe. I put out personal finance videos every single week. And let me know in the comments, which of these 7 reasons is your primary motivation for saving right now? I read everything. I'll see you in the next one.